Very warm welcome, everyone. My name is Axel Threlfall. I'm editor-at-large for Reuters, based out of London. I'm thrilled to be hosting today's webinar, Energy Market Trends to Watch in 25 and Beyond, hosted by the Al-Attiyah Foundation in partnership with London Stock Exchange Group Data and Analytics. It's a big, broad title, so we can really go anywhere we want to go. We have a super panel lined up to throw lots of these big ideas around, and I'll introduce them in just a moment. A little bit of context before we start, although I'm sure you all know the context well enough. From heightened economic and geopolitical uncertainty to changing oil and gas supply dynamics to the ever-increasing expansion of renewable power generation, there is, as we're all well aware, no shortage of factors influencing the global energy system. Brent crude on Tuesday, I think, posted its biggest gain in a couple of weeks. It was pushing $74. We've since come back to about 72, 73. OPEC Plus, of course, meets today, with most expecting an extension to the cuts, and markets, of course, watching Ukraine and Gaza closely. But we can now add to that mix plenty of other bits and pieces, the uncertain context in South Korea, as well as a rebel offensive in Syria that threatens to draw in forces from several oil-producing countries. Other bits we're going to explore over the next hour: the cost of solar and wind, where we are now with renewables generally, the cost of batteries, innovation in battery chemistries and manufacturing, where we are now with hydrogen, which seems to have taken, I think it's fair to say, a little bit of a back seat of late, at least not performing from an investment perspective, it seems. And what of Baku and COP29? Just how confident should we be in the COP process, given the obvious slowdown we've seen in getting the transition done? So lots to talk over, lots of big questions. A couple of housekeeping bits. For the best viewing experience, do read the instructions above the media player. Technical issues during the webinar, refresh the page or reach out via issuerservices@lseg.com. If you want to ask a question, press that ask a question button and we'll do our best to get it in. Don't wait until the end. I'll try and weave whatever you have in through the conversation. We've got a few polling questions that I'm going to fire at you throughout the discussion. The results will hopefully inform us where we go. And a recording of the session is going to be available using the same event link. So let me introduce our speakers. Adrian Del Maestro is Vice President Global Energy Advisory at AECOM. James Henderson, Distinguished Research Fellow, the Oxford Institute for Energy Studies. Kevin Selleslags, Chief Executive Officer at Hygen Energy. Roland Roesch as Director at Innovation and Technology Centre for IRENA, and Bruce Allway, Metals Research Director at the London Stock Exchange Group. A very warm welcome to all of you. Just before I throw out a first question or two, let me bring up the first poll question so you can have a think about that while we get the conversation going. It's up on the screens. Which factors do you believe will most influence energy prices in the next 12 to 18 months? Geopolitics, supply disruptions, weather, gas storage levels. Have a crack at that. I'll bring you the results in just a short while. But Adrian, let me come to you first. I saw a Reuters poll just recently pointing to stalling oil prices in 25, given the ample supply, given economic weakness in China and elsewhere. I think they're saying about $74.5 on average. Even stricter sanctions on Iran from the US administration not expected to help the price much. Give us, Adrian, your overview and throw in there, if you could, how much the US result changes things for you as we head into 25.
Great questions. And firstly, thank you to all the hosts for inviting me to this event. Fantastic to be here. Yeah, so geopolitical uncertainty is definitely the big theme. Personally, I find it hard to be going through a period. I've been looking at the energy sector for some time, where I've seen so much near-term uncertainty. And one of the interesting things, I think, here, you touched on a few issues. We're seeing lots of geopolitical volatility. So we have the conflict in Ukraine, in the Middle East. We have the advent of a new administration in the US with some uncertainty about how that's going to evolve. And if I cast my mind back to the last time where I saw geopolitical events have a big impact on prices, it was kind of the mid-2000s. If you think of when oil prices went up to $147 a barrel, 2000, 2007, 2008, it was a very tight market. You had very strong demand. And I remember an analyst, Adam Szymanski, talking about a geopolitical premium of about $15 a barrel. And the interesting thing now is you see all this geopolitical volatility, but you don't see prices really spiking as much. Certainly with oil prices being a good example, you talked about Brent being in the kind of low 70s, yeah. And I think part of the issue is the volatility is there. You're going to see prices go up and down. You might not see the spikes like we've seen in the past because there's a sense in the market that we're entering a new phase of potential ample supply, and I put that in inverted commas, around oil and gas. So you're seeing the IEA came out recently with some data on this in terms of oil security there from about spare capacity from about 3 to 8 million barrels by 2030, and LNG liquefaction capacity going up by 40% in the same period. So there's a sense there that there's quite a lot of fossil fuels coming into the market, and that's keeping a downward pressure on those commodity prices. The last thing I'll say is, one of the things about geopolitics is I get a lot of clients and a lot of consumers who talk about the fact that as we move into clean energy, we're going to rid ourselves of the bane of geopolitics that haunted the oil and gas sector. The reality is geopolitics is just going to remain a big theme going forward, even with clean energy. You only have to look at the concentration of clean energy supply chains, the role of China there in terms of processing a lot of these critical minerals, being the source of some of these critical minerals, major producers, solar PV panels. The list goes on. Geopolitics is going to be a big issue. And the last comment I'll say is, we're seeing the energy transition evolve. It's going to be a very bumpy ride.
Yeah. Okay, Adrian, thank you for that. And look, I was with a bunch of the oil majors yesterday here in Qatar, and it was interesting. They were saying, yes, lots of uncertainty given the geopolitics, given the change in the US, but they do think it's going to be a story of continuity, at least for the time being. And the overall conclusion on transition is it's been delayed, but it has started. James, let's get the view from you on the gas market. How volatile is this going to be? I imagine the same sort of things impacting the gas market. But talk to us a little bit about supply. Talk to us a little bit about storage issues. I know there are some storage concerns in Europe in particular.
So I think we're in an interim period between kind of now and a couple of years' time, when the kind of fabled wave of new LNG projects is going to come online. And in that interim period, then there's some interesting supply-demand dynamics going on. It's not so much about geopolitics. It's genuinely about availability of supply and different demand in different regions. So we've seen over 2024 a recovery in Asian demand over the summer, which has been fine because in the summer, European demand tends to be lower. At the same time, supply has been pretty stable, hasn't really grown very much. So we've had an element of market tightness developing. And now we've gone into a European winter, which has started with some quite cold weather. I see you have weather as C here on your poll.
Yeah.
So
and by the way, actually, James, sorry to interrupt. By the way, I did get the results for the poll. B and C are the ones that our audience say are going to be most influential. So yeah, you mentioned the weather.
Okay, that's interesting. But well, I mean, I think weather is going to be important for two reasons, actually. I mean, clearly, if it's cold, demand will be higher both in Europe and potentially in Northeast Asia. We've had a cold start, and that is reflected in storage levels. So the European Commission obviously has mandated that storage levels need to be filled to at least 90%. Actually, they've reached pretty much 98% at the start of this winter, which is a great start. The real question is what's going to happen in terms of the drawdown. So already we've taken out 8 to 9 billion cubic meters more gas by now than we did last year. And if the cold weather continues, then it's very likely that we'll end the winter with much lower stocks than we have in the past couple of winters, which obviously means they need to be refilled back to that 90% level over the summer. The second weather question is to do with wind, because that creates volatility. Gas has become very much the support for renewables. And so when the wind stops blowing, gas power plants tend to come back online, and that creates short-term volatility. So we've got two sort of weather factors going into the winter. So it looks like demand in Europe is going to be a bit higher. On the supply side, there are some new LNG projects coming on, but actually expectations have been dampened. Two or three projects in the US have been delayed. So actually on the supply side, things are not looking as flexible as they might have been for 2025. So it's quite likely that we're going to reach the end of winter with lower storage levels than previous years. It's very likely, in our view, that Russian gas flows through Ukraine will cease, which will also reduce the supply levels. And so we'll go into a storage refill period in the summer of 2025, where needing to put more gas into storage in Europe, with rising demand in Asia, when we've seen some dramatic figures in China, India, Pakistan, in terms of growth in 24, which could well continue into 25 if economic recovery continues. And so the forward prices are reflecting this. Actually, forward prices pretty high for 2025 and going into winter 25 as well, to reflect the fact that we have this pretty tight market and storage levels that need to be refilled most likely in summer 25 at a faster rate than has been historically. So no crisis, no gas shortages, but just supply and demand fundamentals that point to a tighter market in 2025 and therefore to relatively high prices.
Okay, good. Thank you, James. To Roland, and my question, I guess, is on solar and wind power costs and what you expect to happen, whether you expect them to continue to fall, what's going to drive these reductions. And if you could throw in there as well your sort of broad thoughts on Baku and where we stand coming out of Baku.
Yeah, thanks a lot, Axel, for this question, and thanks a lot for having IRENA and myself here. I think we see quite positive trends on the global weighted average cost for renewable energies. If we look for solar photovoltaic, the cost came down 60.2%. For offshore wind, kind of 7%. For onshore wind, 3% they went down. And let's say if we look what happened in the past 10 years, then we see that solar PV came 90% down, onshore wind 70%, concentrated solar power by 70%, and offshore wind by 63%. And if we look at the picture, how competitive renewables are compared to fossil fuel projects and comparing the LCOE, you need to know IRENA has the kind of most comprehensive cost database for renewable energy projects. And we clearly see that PV, onshore wind, offshore wind, but also geothermal and hydropower are undercutting the LCOE from new fossil fuel projects in 2023. And looking at the costs, so we see in many projects $4.4 US cent per kilowatt hour for solar photovoltaics. We see for onshore wind even lower prices of $3.5 US cent per kilowatt hour. Looking at let's say the prices and the price situation, the fossil fuel price decrease was driven by a decline in electricity demand during 2023, which was probably an advantage for fossil fuels. But despite the decrease in fossil fuel-fired power generation costs in 2023, renewable power generation continued to be more competitive than fossil fuel options. Looking at the global picture in 2023, let's say 89% of the global capacity, the new capacity added to the generation portfolio, 89% came from renewables. And let's say this is almost 500 gigawatt of new capacity additions, which has a lot to do with the competitiveness of renewable energies. What we see in the global trends from Baku, let's say under the Indian G20 presidency, but also in the context of the COP28 in Dubai, we have been able to discuss and got commitments from the G20, but also by another 120 countries to triple the renewable energy capacity globally. So from 3.8 to 11.6 terawatt hours globally. We see that we are not kind of with solar PV. We are well following this trend. On the other renewable energy technologies, more actions have to be taken. Also in the national determined contribution plans of countries, specifically, let's say also it broaden the number of countries that invest in renewables. We see mainly 5 countries investing in renewables, 85% of the investment needed. And let's say, what are the reasons that could kind of limit a little bit this tripling of renewables? We see, let's say, issues in the supply chain. I think China is dominating the market, for clean technologies. So they have a market share of 75 to 85%. It depends on which technology you look. And this is, of course, taking some actions by the other countries, so trade barriers, and also efforts to diversify the manufacturing of clean technologies may have an impact on the price trends. But of course, yeah, thanks.
Sorry, Roland. Sorry, finish that thought.
Yeah. What we clearly see is China dominating the market and sitting on a big stock of solar PV and also onshore wind technology. They cannot kind of bring into the market for the moment. And let's say these technologies would come at low cost and would, of course, support the energy transition. But as I said, there are also reactions from the other countries that have a different indication on the market.
Okay, good. Thank you, Roland. And look, I'm Bruce. I want to move on to metals now as well, because China is clearly a big part of this story, and some might say the economic warfare that's being waged, in the nickel market and the cobalt market. But just before I come to that, let me just throw out, because it fits here, another of these polling questions. Which sector within the renewable energy industry do you predict will see the greatest growth in 25? Solar, wind, energy storage, or EV charging? So have a think about that while we move on to Bruce and metals. I'd like to talk about lithium. I'd like to talk about cobalt. I'd like to talk about nickel, Bruce. I did see a move yesterday or the day before, and again, Reuters was reporting this. The latest China move on gallium, germanium, antimony, these other metals that are used, I believe, in the sort of the nuclear and warfare space. But there is clearly great tension here. What, Bruce, is happening to metals pricing? What do you expect in 25?
Yes, big question. So metal pricing, I mean, if we're talking critical metals, I suppose in one way, copper is the kind of enabler, right, of the energy transition, because we've got to, move the power from one place to the other. So, I mean, copper is one kind of important story. And there again, I think Adrian talked about concentrated supply. If you think about, okay, it's a more fragmented sector in terms of production, but remember, in terms of smelting capacity, it's all happening in China. So again, these trade wars, which we seem to be going down to, is gonna, there is a risk on just the actual basic, material which are going to achieve the transition, i.e. copper. So there could be, as you said, we've seen obviously the chip wars and the subsidy wars, and China retaliating is not perhaps a surprise. These are kind of well-mature markets they've got their own ecosystem, right? Same with the rare earth elements in China. They've been developing upstream capabilities since the 1980s, right? And then the midstream processing, and of course the demand side. that ecosystem takes a long time to develop, and it's going to be difficult to break into that. So I think, free-flowing trade is obviously important in this energy transition. In terms of pricing, I mean, if we think about it, it's pretty broad. I mean, tin, probably overlooked. That's one, I think, which has been impacted by supply disruption. It's quite concentrated supply. There's a big mine in Myanmar, which was, halted. Exports were halted there by the military rule. Same thing happened in bauxite supply from Ghana and Guinea in West Africa, with the junta halting some exports out of there. So I think this is kind of, it takes us back to the first polling, really, the geopolitics, right? So geopolitics and supply of metals is important. There's a lot of concentrated geology. If you want to talk about geopolitics, I mean, you can't move mineral deposits, right? So, lithium. Let's talk about lithium. I mean, that's probably the most important in terms of the energy transition with the move to EVs. 70% of all lithium resources are in the Golden Triangle, the border between Chile, Argentina, and Bolivia. And Chile is really the kind of only part of that equation, part of that triangle, which has really kind of developed its output. So Chile is a big lithium producer, as we know. But those, kind of highlights the fact that there is a concentration of resource. And of course, 90%, I think, as Adrian mentioned at the beginning, gets processed through China with those those mature supply chains. So I think if you think short term, there's been some macro headwinds for metals, strong dollar, economic slowdown, China construction, everyone's quite well aware. Obviously, the slowdown in EVs as well. We've seen lithium. In 2022, you're probably hard to imagine it was $85,000 a ton. Now it's $9,000 a ton. That's below the incentive price for new lithium mines.
Yes. Yeah.
No new lithium mines are going to come on at 9,000. Well, brine maybe, but not hard rock. So we are in a difficult position. And, if we go down the boom bust, there's certainly another boom coming in lithium. In terms of the base metals, which are going to enable that transition, nickel, you mentioned, that's currently an oversupply. There's a surplus in the market due to additional supply coming on in Indonesia, laterite mining, shallow, easy to extract. So I think, there's some metals. I don't think there's like an incredibly tight metal market at the moment due to, macro headwinds, economic slowdown, and basically a slowing energy transition. But pain is coming, as Adrian said.
Axel?
Yeah, go ahead.
Axel, hi, just a quick comment, because Roland gave a really compelling view of all the positive progress that we've seen with renewables and low carbon power. I always think it's helpful to dispel some of the myths, because sometimes there's a little bit of nuance in this. So with the advent of a new administration in the US, there's certainly a view out there that's going to, at the very least, as you suggested, slow down the pace of transition, in some cases block it. And that administration, for example, is not pro-wind, so there's a likelihood that you might see a slowdown in offshore wind. Having said that, what's interesting is if you look back at wind capacity additions in the US, the largest period where we saw wind capacity additions was actually under the first term that President Trump had. And I think it's important to remember that what's said at the federal level, at the state level, you still see a lot of progress and a lot of investment happening. Texas being a good example, hardcore Republican oil and gas producer, but also a big investor in solar and wind. So I just wanted to make sure the new administration doesn't mean that the transition is going to be stymied. It might be a patchy evolution.
Yeah, no, I'm glad you mentioned that, actually. Thank you. Look, but I want to get to our final speaker just to hear some broad thoughts from Kevin. Very quickly on this poll, 50% was EV charging, 33 we had energy storage, and at 17 we had wind energy. Nothing at the moment for solar. I don't know if that's a surprise, but those are the results of that poll. I want to come back and speak with Roland and Kevin about battery chemistry and innovations and sodium ion and the potential there. But Kevin, let's talk about hydrogen if we could, because I mean, tell me if this is unfair, but it seemed there was a great deal of excitement in this space. It seems to have been tempered a little bit, that excitement. And I mentioned the investment piece from an investment perspective at the start. How bullish do you feel about this space now?
Yeah, first of all, thanks for having me. It's quite fascinating also to observe that hydrogen is not in the poll. It could be an option E. We started at a low. We would have started at a low level, so I wouldn't have been surprised. There is significant growth in the hydrogen space. I'm bullish myself, but otherwise I wouldn't have taken the role on a hydrogen-focused organization. I think you're absolutely right. We're in a corner where there's a lot of concerns and doubts about the future, but I think a lot of these commodity markets have evolved the same way. I think we are now in a stage where the hype seems to be over and we're reverting to what I call reality. And I think the reality is over the last 5 to 7 years in the hydrogen space, there's been a lot of discussion, a lot of talk about the majors coming in, doing 100 megawatts projects left, right, and center, CFDs available in every country in the world, legislation being drafted by major states, and mass adoption from the industrial side. And I think none of these elements have materialized, at least not in a way that people have predicted. But I think that's typical for a commodity where there's no existing market. So the market is forming as we speak. From my own experience in being in the hydrogen-focused markets on a day-to-day basis, we see growth. We don't see the mass adaptation. We see mobility growing. We see industrial customers switching over, and those customers are sticky. So I'm actually pretty bullish. What we don't see, or what the main issue was in the past, is because of all the hype, I think the customers were sitting there thinking to themselves, the molecules will be there. We don't have to do anything. We can just sit and relax, and when the molecules come, we'll take them and we'll negotiate a good price. I think 5 years later, customers now realize they won't come unless there is a supply and demand equilibrium, and which is starting to form. It took a little bit longer than expected, but it's happening now. And I think that's what's needed. And I think we're in a good situation. Actually, we're in a good position where real projects and real companies are now working together, supply, demand, forming those what we call ecosystems. For Hygen, we have a huge ecosystem in the mobility in the construction sector, where we see construction materials and construction vehicles moving into the hydrogen space, buses, coaches, trucks moving to hydrogen, and that creates that demand. So that the pull is there. It's for us to match that with the supply. And on top of that, we have very interesting systems, like for example, in the UK, the hydrogen allocation rounds, where there is actually very targeted subsidies for very specific projects. And I think what has happened now is that, as we said, as the hype is over and reality kicks in, people start working together, and that's what you needed to create a market.
It's interesting, some of the projects you mentioned, because it seems to me Hygen is, and you have to be clever about this, I guess. You're positioning yourselves in that sort of that ecosystem, or you're trying to build that ecosystem between the mega and the micro projects, if I'm reading that right. And that's where you see the opportunity. Can you scale and at the same time underpin these investments? You know, it seems to me a lot of projects don't have the guarantees that industry expects. How easy is it, or how difficult is it to scale if you don't have those guarantees?
I think it needs a combination of. I mean, it's about trust. I think what doesn't, especially in investment markets, what doesn't help, if people come in and say we're going to build it cheaper than anything before, we're going to compete with diesel and other fuels, comparable fuels, and we're going to do it faster and more intelligent than anyone else. I think the reality now, if you have a real project with a real underpinning demand, whether it's mobility, industrial, whether it's other fuels like SAF or exports, for example, in Korea and Japan, I think the market is there. The financial market is ready to go. I mean, yes, you're right. About 5 to 7 years ago, everybody had huge ESG mandates. The rates coming down does help for our sector. I mean, we're not in the upstream oil and gas, so our returns are at this moment in time a bit lower, and it's risky, so that doesn't help. But I think the reality is if you find the right pockets and you find the right ecosystem, there is project to be built, and I think the financial markets are comfortable. We see banks in our space, and you're right. I think for Hygen specifically, we see a nice position between the smaller project, which really defines one customer that needs that has a specific requirement, and there's what we call a mini type project where there is a smallest electrolyzer being built or electrolyzer plant being built, and the gigascale, which are predominantly for exports, looking at Middle East, for example, Australia, potentially US, but it has to be seen now whether it's going to be materialized or not in the next government.
So you still feel you've got a sizable seat at the table?
It's going to be slower than people expect, and I think it's not going to be in the giga scale that people expect, but there's definitely growth, and we see it on a daily basis. We see a new customer popping up. So yeah, the answer is yes.
Well, Adrian, where does hydrogen fit in for you when you look at this whole space?
Yeah. I'm glad you asked me, because I always find the hydrogen conversation fascinating, and totally concur with Kevin's remarks. We've definitely moved from massive hype to a much more sober assessment of the role of hydrogen. I think that's a good thing, by the way. I think that's also, by the way, that's a good lesson for other new technologies. Look at the hydrogen story about managing expectations about what it can deliver. And I think it's going to play a much smaller niche role, but an important role, as Kevin was saying. And I think it's going to be, so definitely industrial applications, so helping decarbonize steel, iron production, substitution of feedstocks and refineries. I can see that being definitely a big growth opportunity. Maybe in heavier mobility, trains, heavy trucks. I think that race to decarbonize light vehicles is electric. That race has been won. Middle transport, think of vans, up to over 1.5 tons. I think that's still either electrification or biofuels. But that heavy goods vehicles, I think there's still an opportunity there. But Kevin alluded to it. Part of it's that classic chicken and egg, yeah? You need to have the infrastructure in place in order to allow consumers to go down that route. And one of the big challenges I think we've had is you've seen a lot of governments spend money, investment, and set up regulatory frameworks to encourage the production of hydrogen. I think more needs to be done on stimulating that demand. And I think Kevin was kind of alluding to it. You need to make sure that consumers have the confidence that if they buy a hydrogen truck, for example, in the UK, that there's a filling station, a network of filling stations that allow you to refuel en route, as well as not just at the depot. That's part of the challenge we have.
Okay, good. Thank you. Look, I want to throw another poll in there. I'm jumping around a little bit, and this is something on the gas piece. So apologies if it doesn't fit, sort of especially at this point of the conversation. But this is the question. I just want to hear what the audience do have to say about it. The IEA expecting gas demand to reach a record. I mean, we've been over parts of this. What do you think will be the key driver of the demand growth? Have a think about that, and I'll bring your responses in a short while when we get them. Roland, I want to come back to batteries and the chemistry and the sort of innovation you think, one, we will see, but two, is really required to keep the momentum going in this space, to keep the excitement going in this space. I mean, I mentioned sodium ion. You know, my son's just done a big project for his A-levels, you know, on this sort of thing, and we were talking about sodium ion. Where is the excitement for you now?
No, thanks a lot. And IRENA is undertaking a lot of studies for the side of supply chains and critical materials of what is needed to make the energy transition happen. And let's say that the result of these studies, and if we talk about EV batteries, you know, the critical materials there are cobalt, copper, graphite, lithium, manganese, and nickel. And just looking, let's say, on the mining capacities, and if you look, for instance, on the total estimated annual demand for lithium by 2030, the demand ranges from 1.7 to 2.3 million tons per year. And let's say looking at the reserves and the resources, they stand at 150 million tons and 560 million tons respectively for the resources, indicating an ample supply. But let's say to make this happen, collaboration is needed. As also Bruce mentioned before, there is a certain concentration of these materials in China. Collaboration needs to happen to make sure the supply is there. IRENA does not see a bottleneck for the critical materials of the energy transition. The reason is there is also innovation. So innovation in reducing the demand for certain critical materials, innovation also in the kind of recycling of the materials that may help sooner on. And then exactly what you mentioned, no? So there is also innovation on substitutes, on alternatives like the lithium-ion phosphide type batteries that can be produced without nickel or cobalt. And you mentioned the sodium-ion batteries could be adopted in the near future for some market segments and can be produced with only minimal use of critical materials. So all these aspects, collaboration and also the innovations and reducing the materials and the recyclation helps a lot. What we have to see is the demand for EV batteries is increasing and production needs to increase 5-fold by 2030. And there actually is the bottleneck. So in the near term, let's say how to ramp up the supply of critical materials. In the longer term, we don't see a problem because all this innovation that I mentioned will happen. But the critical path is now coming in the next 2-3 years. And I think their international collaboration is needed. And of course, also in battery technologies, we see at the moment with Northvolt in Europe, the Chinese are highly competitive with batteries, which is creating some challenges.
And I imagine, yeah, okay, thank you, Roland. I imagine, Kevin, this is a space you watch very closely. And you mentioned the transportation sector, and that sort of fits into that sort of ecosystem that you were talking about. And I live in London, and I'm often following a hydrogen bus around London. What about hydrogen and the spread of hydrogen for sort of passenger vehicles? I mean, I know a few people who drive hydrogen cars, but you can count them on 2 hands.
Yes, a good question, Axel. So I think, I mean, if it's a bus, a hydrogen bus, there is a high probability it's one of our buses, Wrightbus, because I think they're one of the major producers of hydrogen buses in Europe and also looking at expanding into Asia, etc. I think Adrian made that comment as well. I think electrification and of light vehicles, I think is a race that's been run, and I think we also admit to that. I think the passenger cars, except for the Toyota Mirai, and I think the BMW is coming out with a hydrogen range next year, the year after next. There's we see limited activity on the car manufacturing or OEMs on the hydrogen side. But however, a lot of these people started quite early on. They were pioneers. I remember a lot of the Japanese constructors. They started to launch cars without having the infrastructure. It's all about the infrastructure, having the infrastructure out there. And it reminds me of Elon Musk building his charging chargers across the country before he launched his Teslas. And that's exactly what we as an industry need to do as well. We need to make sure that whoever buys that vehicle can easily or conveniently fill it up. It has a lot of advantages. And that's what we're working on. And it cannot just be hydrogen, combination of hydrogen and other players in the markets. But I think the reality is to convert all of the diesel cars and gasoil fuel cars into, ICE into hydrogen-driven vehicles. It requires a significant investment in infrastructure. My feeling is going to be we're going to end up with the heavy-duty transport, buses, coaches, long-distance traffic like trucks, opting for hydrogen. as a solution. And thinking about, we were talking about with a bus operator for example, in Scotland, a bus that goes up and down all day in a town and has to charge 3 or 4 times a day is not a solution. So there's this very specific, and you need to be smart about it. And we're looking for those smart alternatives. Do you think in London everybody's going to drive a hydrogen car? I don't think so. I think it's going to be a nice combination. You will see definitely the hydrogen buses increasing over time as it makes sense economically and also from a practical use case.
Excellent.
All right.
Just just a soundbite here on innovation. Roland made some interesting comments, and I think back to the lithium triangle. Let's think about how green do we want this transition to be? The lithium triangle is in a desert. Well, it's pretty arid, right? And it's a salt flat. There's brine underneath. It's a water scarce area. This evaporation process, you basically pump up the brine, huge ponds, trickle down, and you concentrate lithium. Massive impact on water resources in a water scarce region. So I think the innovation point here, there's a couple of plants at, they're not scaled up, but direct lithium extraction is a process where you literally just have your pump on top of the brine, pumps up, extracts lithium, pumps back into the reservoir. So that kind of innovation is going to move things forward. But as Roland said, the next couple of years is not going to work because lithium price is below the incentive price, right? And they don't work. Thanks.
Yeah. No, thank you. It's a good point there. Look, we just very quickly on this this poll, the gas piece, the results of that. Yeah, go ahead.
Sorry, James wants to say something, I think.
Oh, I'm sorry.
Fine. Give the results of the poll first. I'll speak afterwards.
Yeah, just very quickly, 67% A, 33% B. So really focused on economic expansion, rising European demand. Whether that surprises any of you, I'm not sure. But James, come on in.
Well, I just wanted to reflect on the poll, but also on some of the things that have been said. And I think that gas is just a very good example of, coming back to the COP as well, and the role of fossil fuels and the kind of long, short term. I mean, in terms of the role of gas, I mean, reflecting on the falling cost of renewables, I mean, we see that very clearly in Europe, where gas is being displaced in the power sector, but is still an absolutely vital backup fuel. So, we don't have batteries yet for renewables. And I think comparing the LCOEs of renewables and hydrocarbon fired is a bit like comparing apples and oranges, because one is an on-demand fuel and one is as available. And being essentially an on-demand fuel, gas is there as a backup, and so inevitably sticks around. And I think in terms of this poll, on a demand side, there are clearly sectors where hydrogen can take a role because molecules are required to generate heat. But at the moment, as Kevin's pointed out, things are moving a lot more slowly than anticipated. And so it's not a surprise to see that global gas demand is going to reach a record high in 2025, because it is critical across so many parts of the economy. And just to reflect on the infrastructure point that Kevin made as well, I mean, it's absolutely critical for all these fuels that the infrastructure, whether it's electricity infrastructure, hydrogen infrastructure, is in place. And it's just a fact, unfortunately, that gas infrastructure, natural gas infrastructure, is there. So we have an incumbent that is, relatively low emitting, certainly compared to coal, is available, and the other point I just make is from 2026 onwards is going to become cheaper. I mean, we have relatively high prices right now, but we are going to see a significant surge in gas supply from 26 onwards. So it's likely that gas prices will fall towards the end of the decade, which again, gives you a sort of competitive edge as well. So, I mean, I think much as I'm sure we'd all like to see, I certainly would, a more renewable-based economy and a lower carbon economy, it's just a fact that I think for the next few years, because the transition's taking a bit more time than expected, fuels like gas are going to be around, and we are going to see this trend of higher than expected demand continuing for some while, I think.
Yeah. Okay. Good. Thank you very much indeed. Look, keep your questions coming in, and I've been trying to weave them in as we go, and I've got a wary eye on the time. But there are a couple here. One is on coal, and I'd like to throw this in because there was also an interesting piece I read from one of our columnists recently, and the other is on greenwashing. Let me start with the coal bit. And I mean, I guess the broad question is, why is the production of coal not stopped yet? The piece I reference is that the decline in coal's share of China's power mix is now below 60%. And I wonder how big a milestone that is, because when you pair that with its clean energy clout, I wonder how much momentum that sort of drop. I mean, it's still very big, and they're still using building coal plants, but I wonder how big a part that drop could play in the global momentum in the transition effort. I mean, I believe below 60% is below India, it's below Indonesia. I mean, it's in the right direction. Adrian, do you want to have a go at that?
Yeah, just a few thoughts. So I think coal demand has been surprisingly resilient. And I think part of the issue is this big theme around energy security, the kind of post-Ukraine. Governments are having to figure out how can they make sure that they keep the lights on, and therefore sometimes they have to resort to fuels that would not be normally the first choice, but ensures that they address security supplies. I think that's one big issue. I think the other big issue is you've got, and sometimes it's easy to forget this if you're in Europe at the pointy end of the transition. If you go to the other end of the world, Southeast Asia, China, they have significant coal reserves, right? And they're going to it makes sense economically to use those coal reserves. And if you built a fleet of power stations that are relatively new build, you're going to be reluctant to do anything that undermines the economic model and the longevity of those power. You only have to look at China, which is a tale of two halves. On the one hand, big historic focus on coal-fired power production that led to really poor air quality. And they're now the biggest investor in renewable energy. About half of annual renewable spend is covered by China, big investment in solar, in wind. And they are taking great strides in decarbonizing their economy. 50% of all new car sales are electric vehicles. They are trying to shift that strategic focus on coal, but it takes time. So I think you've got energy security, and I think you've got the realities of having large reserves of coal that some countries are having to rely on for the short to medium term.
Okay, thank you, Adrian. Anyone else want to say anything on the coal bit?
I was raising the hand. I would like to say something about the hydrogen situation. I think Adrian mentioned it, no? So to decarbonize the chemical sector, to decarbonize the shipping sector, to decarbonize chemical and steel making, there is no way, if we take climate change serious, to come around to use green hydrogen to decarbonize this industry sector. And I think that the challenge we are facing there, let's say at least IRENA did a lot of work there, working on the green hydrogen, is the high front-up cost that we see. So to produce 1 million ton of green hydrogen, you need 10 gigawatt of electrolyzer capacity. And let's say to operate this 10 gigawatt of electrolyzer capacity, you need 20 gigawatt of renewable energy, and this is an investment of 30 billion US dollar. I think the promising part here is the very low and cheap costs of renewable energy that may enable this. But if we want to make this renewable hydrogen use happen, then we need to ramp up and scale up, let's say, the economy, which would come with bringing down, and this is actually the bottleneck on the technical side, is the capex of the electrolyzers, which is very high, and also building the infrastructure for such a hydrogen economy is an additional investment. And this is not going to happen. And I think the mentionings here, let's say the optimism is not as big as it was in the past, because the policies under the current geopolitical aspects that have been discussed here already, there is not really the money to make those payments. And that means we need a regulation to scale up the green hydrogen economy. And that means to start to use hydrogen to decarbonize, maybe even with blue hydrogen or other forms of hydrogen, and basically starting with saying, okay, the hydrogen we use, 20% of it in the regulation should be green, and then 30, and then 40, that there is a pathway to come to this green hydrogen economy. Otherwise, it won't work, because nobody is going to pay double the price for green hydrogen as long as the fossil fuel-based hydrogen is a lot cheaper under this geopolitical situation.
Okay, James, you got your hand up, but I also want to hear Kevin's view on this. Go ahead, James.
I just wanted to say, coming back, well, both to the hydrogen, but also to coal. Why is coal still of interest? Well, one reason is it's cheap. And that brings us to one topic we haven't talked about. I mean, the way to get the price up is obviously pricing carbon. And I think one of the developments that was a topic at the COP. I mean, obviously it was Article 6 on voluntary carbon markets, which are about offsets. But I mean, carbon prices are a critical issue here. The European Union obviously has its carbon pricing mechanism and is trying to introduce the carbon border adjustment mechanism as well. But I mean, around the world, we're seeing huge variety of zero carbon prices to the high levels we see in Europe. But until we see carbon price, then fuels like coal are going to remain cheap, and there's going to be a major incentive to use them for economic reasons as well as for security supply reasons. So I just thought I'd throw that in.
Yeah, no, thank you, James. Kevin, do you want to come back on what Roland was saying on hydrogen?
Yeah, thank you, Roland. And I think in principle, I agree on most what Roland was saying. And again, it comes back to my initial statement that the hype is over and we revert back to reality. And I think a lot of people are chasing subsidies. What I'm personally a bit more struggling with is we were saying for the last 10, 15 years, we need regulations, we need the regulations. What I think we actually need is buyers and sellers working together with governments to find a practical way forward, because people were looking at IRA, and IRA is a magnificent piece of legislation, but it took 2 or 3 years and very expensive lawyers to get through the nitty-gritty of it. And even then, there is still zones of gray interpretation. Same with the Japanese CFD program that's there. So the reality is it needs a market. It needs the buyers and the sellers to come together with government and say, this is what we actually need. This is what we prioritize. And create this market. I'm a holy believer that we need to create a market where there is a market pricing. There are signals which allows also institutions to come in and take less, de-risk their positions from a financial perspective. And it's not just the legislation or the regulation. It requires a lot more to that. And it's happening. It's happening smaller than we expected, but it's happening on a day-to-day basis within conferences like this. It's happening around the COPs. People are coming together and looking at pragmatic ways of moving forward, and not just hypothetical ways of dealing with the situation. But I agree, it will require a lot of capital investment. What I do want to make a comment about, and I was in a gigascale factory yesterday, the cost of the electrolyzer is sliding. It's the more project we build, the bigger the project become, the scales of efficiency starts working, economics of efficiency starts coming in. And those electrolyzer costs are coming down, and they're coming down significantly. So an electrolyzer 5 years ago versus an electrolyzer now, while it might be still based on the same technology, has significantly improved. And it's just not the capex; it's all about efficiency. If you have a country where a power price is high, you really need to look at efficiencies. And you look at the newest generation electrolyzers, and they're at least 5 to 7% more efficient than the previous generation electrolyzers, and that's a significant step forward.
Thank you, Kevin. And look, we've only got a few minutes left, and I do want to give each of you just a minute, 90 seconds really, to sum up a few of these thoughts. I mean, we're clearly being pulled in lots of different directions. There's lots happening in the context, whether it's geopolitics, whether it's weather, et cetera, et cetera. I guess the question is this. I mean, this is one way I'll put it. You can play with it however you want. Adrian, let's start with you. What excites you most from an investment perspective as we head into 25?
Good question. So one of the things I always tell our clients when I speak to them about investment is there's no shortage of capital out there. So something like $2 trillion last year invested in clean energy, about $1 trillion in fossil fuels, oil, gas, and coal. The issue is it's not how much money, it's what's the incentive to invest it. What are the regulatory frameworks? Where should the capital be deployed? Where are the returns? And if I think of at a very personal level, I went to an event, I'm not going to mention the name of the company, but let's just say a large European energy company that sponsored an event for clean energy startups, and they had 12 contestants. And by the way, you can go, if you're interested to learn more about this, go to one of my posts. It's all clearly indicated there. And it's just the level of innovation that you see from all these entrepreneurial startups, new technologies that are coming up in terms of addressing climate change, different types. We talked about energy storage. There was one example there of a pumped hydro solution, examples of electric vehicles using swappable batteries. There's a whole portfolio of choices. But what really excited me was just the passion of those people who set up these companies and want to make a change, and the appetite of investors that are interested to pursue those opportunities to make that change.
Okay, thank you, Adrian. James?
Well, I think from a gas perspective, the excitement is all in the non-OECD markets. It's all about Asia, about the Middle East, and potentially longer term about Africa. But I think really in the short term, it's about Northeast Asia, Southeast Asia, and the potential for coal to gas switching, for economic growth to drive industrial demand and gas use there. And I think that's where the gas sector is. I mean, certainly is where LNG developers are focused in terms of new markets, while we see regions like Europe, going into decline as renewables, as has been discussed here, start to take over the power sector, and hydrogen starts to make its mark in industrial sectors. So I think the excitement around investment is very much in Asia and non-OECD countries, I'd say, from the gas sector.
Okay, thank you. It's got to be hydrogen for you, Kevin, of course. But what about what excites you when you speak to investors and when you speak to the owners of the capital out there? What excites you most?
Yes, I think it's hydrogen. I think the answer is hydrogen for sure. What excites me? I want to turn it upside down. What excites me the most, and not just on talkative financial, is the passion of people coming in. We get a lot of proactive people coming out of universities, coming out of institutions that used to go to oil and gas majors, that used to go to the McKinseys of the world and high-paid roles, coming into an organization like ours, which is we are on the front line, right? We are pioneers. We're not the most, I would say, from a pure economic perspective, the most sexy player out there. But they're willing to come in to make a change, to commit their time and their day-to-days to try and resolve this energy transition. So the amount of just highly qualified people flowing in from across the world, trying to make a dent, is super interesting. And I think that's going to make a real change. And talking to these electrolyzer producers, they have the same on a daily basis. They get CVs in from overqualified people from automotive industry, Formula One, that want to come and work in electrolyzer factories, which is 100 years old equipment, if you think about that. But that excites me, and I think that will really change the energy transition. Not tomorrow, but in a couple of years' time.
As Adrian was saying, that the passion of the people and these ideas. Bruce, really quickly, and then to Roland to finish.
Super fast. I think the most exciting thing is the new technology, right? This direct lithium extraction. It's faster, higher recovery rates, reduced environmental impact. So if we want a green transition and do it right, that's the way to go.
Thank you. Good. And Roland, let's finish up with your thoughts.
Yeah, what I clearly see and what excites me a lot, as I spoke about the tripling of renewable energies, the emerging markets are also kind of committed to this. What we clearly see is the investments into renewable infrastructure and renewable energy generation mainly happens in the US, in Europe, in China, in India, and the European Union. So these are the main investors. And I think to broaden up the energy transition to the emerging markets, looking at the possibility of investments of $30 trillion by 2030, is a big opportunity. So the emerging markets taking steps there in ramping up renewables. The big challenge here is the kind of risks that are perceived in those markets. We try as IRENA to work on instruments to mitigate the risk and bring the emerging markets in a better position. In the first place, to open up the investments, the diversification of supply of green technologies is an important step. And in general, what I see for the kind of more G7 countries, the European countries, is let's say what has been mentioned here, looking into the green tech innovations, ramping up these innovations, creating job advancing the industry, and to overcome this critical step where we are now in the energy transition, that the old industry disappears and the new industry is not creating business and commerce and jobs in the same way the old industry is passing away, is an important step to be overcome. But I'm quite optimistic that can be achieved by the end of this decade.
Okay, very good. Look, I always find it energizing talking about this, and I really thoroughly enjoyed your thoughts over the past hour. Particularly when we talk about the passion of the of the people to get a lot of this stuff done, the innovation, the entrepreneurial spirit, etc., etc. So to Adrian, James, Kevin, Roland, and Bruce, many thanks. There's a thanks to the viewers as well for responding to the polls and sending through questions. That code, the QR code, do scan that and you can fill out a post-event survey. This, of course, has been a joint collaboration between the Al-Attiyah Foundation in partnership with the London Stock Exchange Group Data and Analytics. Of course, Reuters editorial is involved when I step into the ring as well. But thanks very much to everyone, and we will see you next time.